Good morning, Hoppy. Sorry to be a few minutes late on that.
That's all right. That's all right. I appreciate you coming on. Now, so as I just explained earlier, that the tax reform plan, which talked about getting rid of the income tax and at some point phasing down the corporate net and replacing it with an 8% consumption tax, that the fiscal note, the fiscal report came back from the Department of Revenue and said, well, if you do that over 4 years, you're going to be down about $870 million. So that obviously threw some cold water on the plan you all have been working on. What is your reaction to that report, and where do you go from here?
Well, actually, what I would say is I'm not sure that I would say it threw cold water on the plan. When you're doing any type of legislation, and you've been down in the Capitol often enough to know, nothing starts the way it finishes.
Mm-hmm.
And so it was really important to get the fiscal note. And what I would say is we had a particular range that we thought things would land in. And, it's on the low side of that range, but it's not outside of that range. And so what we do now is we go to work to figure out how the bill needs to be adjusted in order to meet the revenue needs of the state.
Senator, one thing is that this was a pretty quick scoring by Mark Muco at Department of Revenue. And I think he said, and I think it's been mentioned by others, is that you probably need more thorough study, more even dynamic scoring, as they call it, where you could look at this more thoroughly and say, well, okay, how much leakage is it? How much business would you lose to surrounding states? Can you quantify that? How much business growth would there be? Can you anticipate if you made these changes? So there needs to be more scoring, doesn't there?
Well, I think on the second part of the question you asked there in terms of how much growth do you get and those types of questions, one of the things that's important to keep in remember related to the tax reform proposal that we put forth is that it's intended to be revenue neutral based on our current, economic output. So if we have growth, then that's, what we call icing on the cake.
Okay.
But the intent was never to anticipate growth and to try to say, hey, if we do this, we're going to get X amount of growth, and then the budget will have this much more money. We tried to stay very much away from that because when you look at some of the experiments that have been run around the country where they sort of try to guess how much growth it'll be, and then they cut their tax, revenue stream to match this anticipated growth, too often they fall short. And so from day one, our intent was never to try to anticipate growth. It was to produce a model that generates the needed revenue exactly the way our state runs today. And then the growth will just be the icing on the cake.
Senator Robert Karnes is with us, Republican Upshur County, who is chair of the Senate Select Committee working on tax reform. Senator, a couple of questions that came up for Muco, and I think are legitimate questions, is that if you have an 8% consumption tax and very few, if any, exemptions, that would be, as Muco said, that'd be the highest sales tax in the country. How concerned are you about losing? But you're in Upshur County, kind of a middle of the state. How concerned should border communities be about losing business to surrounding states that have a lower tax rate?
Well, a couple of things on that should be pointed out. From a state perspective, that would be the highest statewide tax, sales tax in the nation. That's true. It would be far from the highest sales tax in the nation, though. We've got states like Tennessee that are 9.5% on average. So we would be well below that. We've got states like Washington that are right about 9% average, so a percent above that on average. And we do have, obviously municipal taxes, but they're not really widespread enough to have that kind of effect on our average. So 8% statewide might be the highest in the nation for a state, but it's nowhere near the highest. And there's at least a dozen states that have a higher sales tax cumulative total when you look at the state, the county, the local, and so on.
No, go ahead. I'm sorry. Go ahead.
So I'm just saying that's part of what has to be kept in mind there. And then the question about bleed over, Mr. Mucow even mentioned a particular study that was done by someone at WVU a few years ago, and I asked him to send me a copy, and he did. And what I saw in that study was a question related to food tax going from 0% to 6%, if I understood it correctly. And I've only had a chance to glance at that report, but what I came away from it seeing was that the estimate was about a 4% bleed over. So you lose 4% of your revenue to bleed over on that particular issue. What I would say is that, Mr. Mucow scored the fiscal note conservatively, which is good because we don't want to overestimate, again, what revenues we're going to get. But his reductions add up to, perhaps 10% or more already. So well beyond the 4% that's in that study.
Senator, I think, again, the Senate Select Committee deserves credit for taking a big bite at tax reform and seeing if there's a different way or a way to make the state's tax system simpler, flatter, and easy to collect, and just all those attributes to collect the revenue needed to operate the state. However, again, that fiscal note is pretty significant. So, do you go back to are you going to go back and retool it and then continue to push it this session, or do you say we need to study it some more? What are you going to continue to push it as hard this session as you were before that fiscal note?
I think so, and I think the answer is, yeah, we retool it a little bit, specifically to answer the questions in the fiscal note. So, for example, what I'll give you is, you have a revenue shortfall. And I think you gave a cumulative number, but the highest shortfall that we saw in any year, the third year out, was $610 million. And that's a rough equivalent to 1.5%, okay, in terms of the current income tax. So what that tells us straight out is, with no other factors being considered, a 1.5% income tax, which would be almost 4% less than our current effective income tax, would be enough to close that gap. And a 1.5% income tax would generate a lot more growth than the 5% that we currently have for an effective income tax rate. So again, we knew from day one going in that bills change based on information that you get as you go through the process, and we were completely ready to make adjustments. And so I think we'll actually have a bill ready by the end of the week that addresses many of the concerns that were raised by Mr. Mukow. And I think we'll even have that scored again by Mr. Mukow by the end of the week.
Senator, finally, this always comes up, and I'm not very well versed on this, quite frankly, is that how much are we losing, and I don't think it was in this report, how much are we losing in sales tax in online sales, and is there a way to capture that? Do you know?
Well, a couple of things I would say. One, we're probably, in terms of the online sales, collecting well over half of the online sales. And the reason for that is some of the biggest online retailers that there are, Amazon, Best Buy, Walmart, these guys all have what's called a nexus in West Virginia, which means that even though you may buy something from Amazon online, we still pay sales tax in West Virginia on Amazon purchases. I'm sure everybody who buys from Amazon realizes that. Well, just Amazon by themselves accounts for 30% of all internet sales. By the time you throw Walmart in there, Best Buy in there, Target in there, you're well over 50% of all online sales are already taxed in West Virginia.
Okay.
So is there bleed? Absolutely there is, but it's not as bad as what it might seem when you first hear the story.
Got it. Well, good point. Senator Robert Karnes, Republican, Upshur County, and also head of the Senate Select Committee on Tax Reform. Senator, it's good to speak with you. Thank you for coming on.
Thank you, Hoppy.